I've had quite a few clients come up to me recently. They've now gotten funded accounts and now managing their funded account, but they've got a new set of problems and now they don't want to lose that funded account. They don't want to hit the drawdown buffer. So I spent some time creating a new risk model protocol that I've shared with my clients and I'm going to share with you today. I'm going to take you through step by step this new risk model strategy that you can implement into your trading to ensure that you don't hit the drawdown buffer, whether that's 10%, whether that's -4%, whether it's -12, whatever it is. I'm going to give this to you to ensure that you don't hit that drawdown buffer and you can continue to scale your funded account and continue to manage it for the long run. Now, if it's the first time checking into the channel, first and foremost, welcome. My name is Bailouni and I'm the founder of Master Your Trading Mindset, which is an education and performance coaching business. Now, we work with traders all around the world, thousands of them, helping them lower their emotional volatilities in the market and increase consistency in the market. If you don't already have a copy of our free Bulletproof Your Mindset tool, for God's sake, go in the description and get it. It is extremely useful and valuable, helping traders all around the world lower their emotional volatilities, increase consistency, and it's completely free. Check it out. What I've observed with the best traders is that they're not necessarily resentful to the funded accounts rules or drawdown buffers. They constantly ask themselves, how can I use this to my advantage? So one thought process I promote is if there is a -10% drawdown, great, use that to your advantage. How can you implement that into your trading plan? How can you adjust your trading plan to make that work? And one thing I've recently created or come up with is a risk management protocol that you can implement to increase the amount of losses you can take before you hit the drawdown buffer. And all you're going to do is adjust risk accordingly on a gradient, which I'm going to run through step by step right now. So let's say you have a 10% drawdown as a trader, from 0 to -10, and -10 you lose your funded account. Now within that 0 to -10, if you're risking 1%, you can take a few more than 10 trades if you're risking 1%. Because you take a $1,000 loss, your account goes to $99,000. You risk 1% of that, it's $990. You take a loss, you risk a little bit less the next time. So the math works out a little bit more than 10 trades you can take before you hit that 10% drawdown buffer. So what I promote is some form of a traffic light system. Between 0 and -5 is a green light. That's still a safe zone, right? Between 0 and -5, the drawdown. Between -5 and -7.5, it gets a little bit closer to that drawdown buffer, so that's an orange light. And then between -7.5 and -10, you're getting pretty damn close to losing that account, so that's a red light. So you're creating a gradient scale to the risk in your mind, right? And if you have different perceptions of risk, the closer you get to that -10, it, in my opinion, is wise to adjust your risk, how much you risk, to accommodate for that. So what I promote is between 0 and -5 in the green light zone, risk your full amount. Let's say, for example, you're risking 1% per trade. Risk 1% between 0 and -5. But then when you get in between -5 and -7.5, a drawdown on your account in the orange light, half your risk. So now instead of risking -1, you're risking 0.5%. And then when you get into the red zone, half that risk again. So instead of risking 1% or -0.5, you're risking -0.25%. You're risking 0.25%, I should say. So in green light, you're risking 1%. In orange light, you're risking 0.5%. In red light, you're risking 0.25%. And what you're doing is you're scaling your risk down incrementally the closer you get to hitting that drawdown buffer. And what that does is it almost doubles the amount of positions you can take before you hit that drawdown buffer. Now, from a psychological perspective, the more time and space you have, the lower your emotional volatilities. So what you're doing is you're giving yourself more losses at the end of the day that you can take, which lowers the emotional volatilities. If you take a win, the wins are less elating. If you take a loss, the losses are less depressing because you have more time and you have more space. So by implementing this risk model that I just explained, and you scale your risk down the closer you get to hitting that drawdown buffer, depending on what zone you're in, you increase the probability of making more process-based and objective decisions because you're not run emotionally. If you have only a certain amount of losses that you can take, the closer you get to that, the more you're going to fire your amygdala and make irrational decisions out of fear and out of greed. But the more space and time you have, the more you're going to have your prefrontal cortex online. You're not fearing the consequence. You're making process-based decisions. So I encourage traders, once they get funded accounts, to implement something like this. I've spoken to a lot of traders who are trading a lot of capital, and they have their own risk protocol, something of the sort like this that they're implementing, because they know it's wise. They know that they don't want to necessarily be risking a significant amount when they're deep in drawdown, because they know they're going to be making irrational decisions. So be smart about the funded account, implement something like this, some sort of risk protocol that isn't too aggressive. It's very scalable, it's very process driven, it's very reasonable. And I guarantee you'll take a lot of pressure off your shoulders with these funded accounts, and you'll probably end up making more money because of it as well.